Hello, everyone, and welcome to the Property Trio. It's Cate Bakos. I'm joined with Dave Johnston and Mike Mortlock, and we were just marvelling that we're only a handful of episodes of 5 years worth of recording. How cool is that?
Pretty amazing, isn't it?
Yeah, I remember the very
when
first
you're having
ones.
fun.
Well, our pilot one, Dave, that we did in your office in Camberwell before lockdown and change of venue. And Pete flew over and we had all of that recording gear borrowed. My goodness, we've come such a long way. It was a huge day, though.
Tired thinking about those first 3 sets of 7 recordings in one day.
Punched them all out.
Oh, my gosh.
Oh, and we've got a good cadence now. Oh, lots of fun. And we have even more fun now with the court jester in the room. The three of us, we get together.
Isn't it?
It is you. Yeah, you're out of the naughty corner.
I'll just coast in at the last minute for the 5-year party.
You can. You're a part of this, Mike, and it's reshaped since Pete stepped away, and we've loved each week of recording, and we're really enjoying, in particular, bringing real life case studies and listener questions to life, because we have lots of material and lots of stuff we love to talk about, but it actually really takes shape when we get someone giving us their story and their trust to bring it to life. And that's what today's episode is all about. I've got a wonderful question from Kim, who reached out to us not too long ago. And I really felt for Kim, and her question is so important. It will touch many people in Australia. So I'm going to read it out. I'm a single mum of 2 teenage kids and I'm a business owner. I pay $600 a week rent, which is going up to $680 a week in a few weeks. I've been trying to obtain a housing pre-approval for a few years now. I'm hitting walls every which way with banks due to interest rate rises and harder rules around lending. Is there a way I can buy into a housing scheme so make my money work for me in the short term to up my deposit? It's a great question. Now, Kim is not on her own here, and this is a particularly challenging scenario for a few reasons. She has 2 dependents. She's a business owner. Her rent increase is biting into her living expenses and her borrowing calculations, and this challenge is amplified by rising interest rates. And Kim's also touched on tougher credit policy too. And Dave, I'm glad we've got you in the hot seat to answer this. Can you chat through business ownership and the challenges that self-employed workers face in terms of lending scrutiny and credit requirements? Because it's very different to those that have a pay slip from their employer.
Yeah, look, it sure is, Kate. It's a real challenge for many people who are self-employed when they're trying to get finance, and often they feel that their tax returns don't reflect their true income, and that can be because they think they're able to claim more tax deductions than the average person. But ultimately, if you're able to claim a deduction as an expense, well, it should be an expense that's going towards the business. So probably one of the big killers is the fluctuation of income, so the ups and downs. And really, generally speaking, when you're going for a loan as a self-employed person, you're looking at 12 to 24 months ago. So you might be having a great year, but, this financial year won't have been completed. And often we don't, us business owners tend to be a bit slow with completing our tax returns. Most of us, I certainly tend to be about 6 to 9 months into the year.
I love it.
If I'm doing well. So it can be a matter of timing. Most lenders will take averages over 2 years. Some will take the worst year of the last 2 years. So look, there's a lot of challenges there. And I just want to touch on a few stats, because I'm a bit of a believer in the importance of small business as a driver of the economy. And, and I think there's quite a few stats suggesting it's getting harder and harder to run a small business. There's a lot of stress involved in running a business, but if you know someone who runs a business, you should go out and shake their hand, because they comprise 97.3% of all businesses in the nation. They employ around 6.8 million people. So that's nearly half of the country's total employed workforce. So this is defined by businesses with 0 to 19 staff. The average small business owner's income is around $99,000, which is pretty much in line with the average wage of a salary earner. So the average small business owner is only earning the average salary plus all the headaches involved in running a business. So, look, shout out to all the business owners who have listened to our podcast. We feel your pain. The three of us are business owners and know the challenges and ups and downs of running a business. So, it can be quite challenging to get finance.
I agree, Dave. To be honest, it gives me the shits, this term self-employed, right? Like I'm defined as being self-employed, but, there's 30 odd of us in the team. It's not just I work for myself, right? Like my pay slips, you can kind of take to the bank, right? Well, but you can't actually. Yes, they're not happy with it at all. Even a rental application, it's like, well, as the business owner, you can doctor your pay slips. So I'm like, oh, really? Is that where we're at? I think it's bloody hard. It's far more difficult to get a loan when you run a business rather than being an employee. And I think that should change. I'm sorry, we probably can't change that for Kim's situation, but if there's any policymakers listening, let's sort it out.
Well, it is hard. Now, to amplify the difficulty here, I've mentioned a few other things. I want to also ask you, Dave, about dependents, because, we think of our children as dependents and we get this, loving aura around us. But let's talk about the bank's view of dependents and how it impacts someone's borrowing capacity. Can we get you to shed light on that?
Well, look, once you have a child, it impacts your borrowing capacity quite significantly.
Yeah.
And Kim has a couple children. So, that's certainly a large impact on her borrowing capacity. Now, they're expensive. So, it does add a fair bit to your overheads.
Mike, let's talk about the rental increase that Kim's facing as well, because we've spoken about rents in a lot of our recent eps, and 13% increase is particularly rough. How does that compare with rental increases around the nation?
Well, it doesn't really meet the market, but what's at play here is that we don't necessarily know whether the rent was below market at, 600. So they're in, the landlord's entitled to bring it back up to market, but, we're talking, what does that work out to be, like a 13% increase or something like that? Yeah. I mean, if you look at the annual change in rents to December 2023, the only place that got close to that at 13.4% was Perth. Sydney was 10. Melbourne was 11. So on face value, it does kind of seem a little bit rough. I would encourage Kim to try and do some sort of comparative market analysis on the rents. And we do know from the Australian Property Investor Sentiment Survey, which we did an episode on, and insert the number later, that 2/3 of landlords aren't prepared to increase the rent if they risk losing a good quality tenant. So just because the real estate said, it's going up by 680, I'd encourage you to sort of say, look, can you give me an idea of the comparables to that? Because it's quite a big jump. And, is there any negotiation on that? Obviously, tenants, unfortunately, are not in a strong bargaining position just because of the crisis levels of affordability and vacancy rates. But, you're certainly within your rights to say, look, can we negotiate on this? And there might be something there. But it's definitely on the high side if she was already at market.
Yeah, I absolutely agree. And so there are some things that Kim can do if she feels that the increase is unfair or unsubstantiated.
Yeah, how would you approach that, Kate?
Well, no one wants to go to the tribunal. Ultimately, though, that is the option that a tenant has if they've got a landlord that's being unfair. The first thing that I would do before you accept the rent increase and sign it, and I might assume that Kim has accepted it because she said that it's going up. If it's unfair and unsubstantiated, you'd talk to your property manager first and foremost, and you'd present them with your workings or your comparable rents and just have that conversation. Because the last thing that property manager wants is, an argument between renter and rental provider and a chance of having to take it to the tribunal. But I've seen situations and certainly read about countless situations where the renter has won the case, the member has granted them the lower rent. And if there's been a situation there where they've had to be rebated, they've had a credit. So there is definitely an option there for renters if it's unsubstantiated. The hardest thing about this climate that we're in is we've seen massive rental growth, and we've talked in many episodes about what's driven that and why it's happening. So 13%, as horrible as it sounds, is potentially plausible. And as you said, Mike, it might have been a little bit under at the start. I don't know. So ultimately, though, Kim hasn't talked about fighting that. Kim just wants to get her own place. And that's what we're going to chat about today. So, Dave, let's talk about the housing schemes that are available.
Yeah, look, so a bit of a high level on a few of the housing schemes that are available. You've got your first home guarantee. It's also known as a first home loan deposit scheme, which the government guarantees part of your deposit. This one allows first home buyers to build or purchase a newly built home with a deposit as low as 5% without having to pay lenders' mortgage insurance. And the government will guarantee the remaining 15% of the deposit required to avoid lenders' mortgage insurance. The scheme has been extended up to 10,000 places and promised to get to 35,000 places per annum. You have the First Home Super Saver scheme. So this is where first home buyer can contribute extra money into their superannuation. That's up to voluntary contributions of the value of $50,000. This is a really good initiative because you're only being taxed at 15%. So as long as your tax rate, which it is for most full-time workers, is above that, at least 30 cents in the dollar, you're effectively saving 15% extra of every one of those with that $50,000 investment. So that's definitely something first home buyers should look to do if they can afford to. You've still got to be able to afford to put that money away and not need it for your day-to-day cash flow. There's the family home guarantee. So this is one, Kim really has the double whammy of, challenges with lending. I think the biggest challenge with buying a property in today's day and age is being a single person with the last 20, 30 years of dual income households. So this one's for single parents with dependents like Kim. So the scheme allows single parents with dependents to purchase a property with an even lower deposit. Single parents need only 2% deposit. You'll generally still need the extra, 5% for stamp duties and what have you. And the government will provide up to the extra 18%. So there's also the regional first home buyer support scheme. So if she's living in a regional area, this is also provided by the government. This guarantees a new initiative introduced with 10,000 guarantees on offer over the next 3 years. Similar first home guarantee, the required deposit is low as 5%, and the guarantee is offered for newly built homes only. Key difference is that this is offered to permanent residents as well as Australian citizens. So that's the key difference there. So trying to help some non-Australian citizens, in essence, to get into the market and buy in the regions. So trying to get more of our new Australians out into the regions to support the regions is the plan there. There's so many of them. I think that's makes the landscape really complex. I'll give you just one more. The Help to Buy scheme. Yeah. And the government funds some of the upfront cost of a home in exchange for equity in the property. So this is an interesting one where they'll contribute 30% of an existing property or 40% of new. Again, you see they're trying to incentivise that more new property to be built. Yeah. And this one, again, you only need 2%. You won't be paying mortgage insurance. Can get you into a more valuable property, but the government will be,
they'll be your partner in crime, won't they?
They'll be your partner in crime. And they'll take some of the money on the way out.
Yeah,
I always said that like Barnaby Joyce would come and stay in your spare room, like when he needed a place to stay. Right. I think that's part of the fine print. The thing with the single parent announcement. And, that was a great thing that came out of the budget, especially the measures for people fleeing domestic violence situations, being a single parent. There's only 5,000 places in the next financial year.
Yeah.
And I read some research that said that just because of divorces in last financial year, it equated to an extra 120 odd thousand homes being required. So it's not commensurate with the size of the problem. It's great if you can be one of those 5,000, but honestly, it's a tough slog getting that spot. But Dave, that's where like a broker would be across all of this all the time. Is that fair to say?
Look, I'd say it's fair to say that a really good broker would be across most of this all the time. But I think it's very difficult to be a 100%, have it all stored, 100% knowledge in your mind, along with the 40 plus lenders change. But the thing is, they'll know enough to be able to, and then they can do the research for you. They can point you in the right direction. So a really good broker, is really the place to talk to. And I'd say anyone who any of these schemes interest, make sure you're listening to them. Who is listening, make sure you listen to the names of them and then go and do a bit of research on them yourselves or talk to a strategic mortgage broker.
Yeah, I think that's great advice. And Mike, you're on a bit of a roll with this one. The family home guarantee, I thought about that first and foremost when I got Kim's email. And you're right, 5,000 places is not enough. If you're on the front foot though, could you do it? I'm going to get you to talk through the eligibility, what this all means, what's in it for the recipient, and what do you have to do to be eligible for this deal?
Yeah, well, I think it starts 1 July, so you'd want to have your ducks in a row for one of those 5,000 places, and of course you need a participating lender, and I couldn't tell you which of those are, but there's also
often.
Beg your pardon?
Often they only have a few lenders who they'll work with, which is another restriction with a lot of these schemes.
Yeah, and I think, the big restriction is also going to be the caps as well. So Sydney and regional places, big places like Newcastle and Wollongong, we're talking caps of 950, regional New South Wales 750, Victoria for Melbourne and Geelong it's 850, regional it's 650, Brisbane 700. So that doesn't give you a lot of wiggle room. And I know that, Cate, you'll know better than anybody what that buys you in places like Melbourne. But for 850, I mean, is that suitable for a single parent that is the guardian, or let's say the parent of, a couple of kids? It doesn't give you a lot of wiggle room.
I had a conversation with a politician about this not long ago, and aside from not having enough places available on what otherwise is a very good initiative, I also query the price points, because you've got a situation like Kim's. Kim's running a business and she's already paying sizable rent. And I can confidently say there aren't too many places in Melbourne that would be capped at $850,000 that are charging $680 a week in rent. You'd expect that at $680, the cost of your property would be greater than $850. So it's a little bit out of whack with the yields that Kim's talking about. So this may be insufficient for her. Or she might have kids that are happy to share a room, or they might be prepared to be in a 3-bedroom apartment or move further out. There are obviously some compromises here that we need to chat about, but I think these numbers aren't quite high enough. And if people do have multiple children, because at the moment to be eligible you just need one or more children, they will want extra bedrooms. So I think the caps do need to be considered. And clearly, if you've got the capacity to service the debt at a higher level, then that, I think it should be something that you're eligible to do. As you said, Dave, saving up that deposit and getting over these hurdles that Kim's experiencing, and many people will be. You've got rent, cost of living, running the business, having the kids. If you're able to get into a home that isn't costing you very much more to hold, but you're getting help with your deposit, I think that's the real value in this particular offering.
Yeah, I think it's somewhat discriminatory against single parents who perhaps they're not affluent, but they're middle, lower, upper middle income earners. and, you know, those price caps limit them. And also, I think, you know, earning 125,000 per year or more, I think, you know, that could push up as well. It's still,
Yeah.
you know, it still is a struggle for a single parent. And let's face it, if they're earning 150, that's like two, you know, in a couple where they each earn 75,000. But it's not actually, because you're paying more tax as one person earning 150.
Mm.
So, you know, it's actually probably more like they need to earn 155, 160 because of the higher tax bracket. So I just think those numbers are all a bit too low. I think, you know, we look at median incomes, but we know, generally speaking, income rises as we get older. Often, you know, single parents are going to be older, you know, so they're probably going to have a higher average median age. So I think we should also be looking at what's the actual median income of a 35-year-old or a 40-year-old, and you know, work more in and around that space and look at the standard deviation. But I do agree 100%. I think a lot of these numbers are too low and too restrictive, and there's still a lot of people who could really use this assistance who won't be eligible.
Imagine having a big crack at the financial year with the business to try and, you know, get a little bit better looking on paper, but then you miss out on one of the grants because you've earned too much. Like that's a real potential scenario for people. This is where I think the self-employed stuff is it's pretty onerous on people.
Yeah. And look, we're dealing with a rental crisis, and the fact that Kim's rent has gone up 13% in one go, if she was eligible for this deal and could step into home ownership, that's one more rental property that's freed up for someone who hasn't got the capacity or the need for a home loan. So I think politicians and policymakers could do a lot better with some already existing policies that are good, that could actually be great.
Yeah, 100% agree.
Now, there are state-based initiatives also, from shared equity to stamp duty concessions, and these are all options that I think Kim or anyone in Kim's position could be looking into, because you can have them in tandem. It's not a case of double dipping, not being allowed. You've got to look at what you're eligible for. And obviously, if Kim's purchase price was under 600,000, which again could be really difficult, but it depends on where she's living. We haven't got that detail. She could be in a regional area or a capital city where that is a possibility, and she could then be getting some stamp duty concessions. I also want to talk about affordable housing. And there's a difference between affordable housing and social housing, and this is all, you know, very strongly in the media at the moment. Mike, are you happy to chat about this?
Yeah, I had a look on the website of the announcement, and it's actually really interesting reading, because it has a red hot crack at the Greens and the Libs for trying to block the housing fund. No, I'm more used to the Greens and Labor being, you know, best buds, but they really butted heads on this particular policy, and you can actually read it on the website.
Yeah.
You know, there's the 10 billion Housing Australia Future Fund with the idea of building 30,000 affordable homes within its first 5 years. And already I just kind of think, like 30,000 in 5 years, like it's sort of farcical. Yeah, I know it's ridiculous. You know, so 20,000 new social homes, 4,000 allocated to women fleeing domestic violence and older women at risk of homelessness. I mean, that's great, but I don't think it goes anywhere close to the need. For frontline workers, you know, they've allocated 10,000 affordable renters, but I'm assuming that Kim, working for herself, is not a nurse or a police officer. You know, there's 100 million for crisis accommodation. That's not really helpful. You know, 30 million to build a housing fund for specialist service for veterans and those sorts of things. So, you know, these are great policies for politicians to stand in front of a lectern and say that they're doing things and they care, but it's nowhere near enough.
Yeah, it's not enough money. It's not enough houses.
Mm.
Yeah, absolutely agreed. I want to circle back to Kim's original question before we go on to one more listener question. And that is there a way I can buy into a housing scheme so I can make my money work for me in the short term as I save up my deposit? And, that's a very clever thought. But also I think my opinion of this is the sooner Kim could get into a property, the better, because the risk that she is facing is whatever she puts her money into and invests it in, if the market outpaces that, there's an issue there. But also, if she can be in the market, she's getting the benefit of leveraging with a loan in place. And of course, your gains are then multiplied. So I'm not sure how you both feel about this. Is there a housing scheme that Kim could contribute to? Look, there are housing trusts and there are other opportunities, but I'm nervous about that for the reasons I've just highlighted. Dave, what are you thinking?
Yeah, I think actually some of the non-government shared equity schemes, from my experience, they tend to be more flexible, less onerous, more simplistic, and more. Yeah, I think they're worth looking at. Here's a name of a few: Longview, Own Home. There's a couple, and really, if you want to get into a higher value property and you want to get into the property market and you just find you just can't do it with your borrowing capacity, and perhaps in the area where you're happy living and all these schemes, are at a lower price point, or, you just don't fit their requirements and specifications, I think something like that is worth looking into, where they do contribute that 20-30%. Like often like Longview's one, we've got actually a pretty well-off client based in Sydney who's working with them at the moment, and it's actually helping them. They could afford to get into a property worth about 1.5, but where they live, they need to spend about 1.8 to 2.2. So they're actually working with Longview, for example, at the moment. So basically, they'll put in up to 1/3 of the deposit, but they will, keep one third of the capital growth when the property is sold or when you pay them back. So that can be a way to get into a higher value property that, is where you want to live and the type of property you feel like you need to, raise your kids, and you make sure they're not both in the same room, because I can assure you kids never select that option. It's the parents who require them to share rooms at times, because, you can only have so many bedrooms at times subject to your house and where you live in affordability. So, yeah, I think they're worth looking into for Kim.
I think that reading the fine print and really understanding the deal and all of the aspects of the deal, how you get out of it, how you pay it down, what happens if you upgrade and trigger a sale, understanding all of that and comparing is really important. And of course, understanding how to get into the opportunity in the first place.
Yeah, the devil's always in the detail, and all of them have downsides.
Yes, of course.
Cons. Yeah.
Yep. Before we move to the next question, do either of you have anything more to add?
I think you hit the nail on the head with the real value, and that's the leveraging, right? Like that's the way that people make money in real estate, right? You're putting down X amount and you're taking a loan for the rest, but you still get to keep all of the capital growth, right? And you hit the nail on the head as well when you're kind of saying, look, the investment's got to at least match the market, but ideally outperform the market. And, if we're talking index fund or equities, that's a pretty uphill battle at the moment because the market is kind of galloping along.
Yeah.
It's a big exercise. You really have to sit down, crunch the numbers in quite a sophisticated way. And if you're getting into any of those private schemes, you need some good legal advice to make sure that you're covered, because the worst case scenario is that you're actually in a worse spot than if you did nothing, and that can happen to people.
Yes, that's right.
Yeah. I mean, with a shared equity scheme, as long as you've got a property that's performing reasonably well, you're going to be sharing generally 2/3 to 80% of the equity. But then, there's fractional, there's crowdfunding platforms. So fractional investments where you buy smaller parts of properties. You know, you have real estate investment trusts, unlisted property funds, but that's more getting a footholding into commercial property. So, yeah, I think if you can't afford to buy a property, probably a shared equity scheme is the next best bet, but it's making sure you get the right one.
Yeah, absolutely.
I think also, sorry, I should have mentioned this before, but I think it's also, as a small business owner, it's important that your accountant works with your broker, because there will be certain things that the accountant can certify, well, that is only a one-off expense and shouldn't be calculated in part of the serviceability calculation. So there might be some add backs. So definitely a worthwhile conversation with your accountant and your broker, and ideally getting them both together and saying, all right, well, what about this big expense? Is that an ongoing one, or is that a one-off? Like, how can we actually have an accountant to certify and say, well, the real figure would be this if we take away these one-off expenses? And I've been fortunate enough to witness that happen in person before. And yeah, it's quite magical to see what could actually be done to kind of massage those figures a little bit better.
Yeah.
I love it, Mike. That's a perfect gold nugget, that little mention of add back.
We'll call it mine then. I'm done for the day.
All right. I've got one more listener question, and I think this is a shorter question for us to answer, but it's a goodie. Claire has asked us about a bit of a dilemma. How does property planning complement or contradict traditional financial planning? We've been working with our financial planner for 10 years now, and we've been largely satisfied with all things money management, insurance, superannuation, etc. However, recently we've found ourselves being told repeatedly what we cannot do rather than exploring options around what we can. Should we choose one or the other, or can we continue with both? What do you do with a financial planner who is anti-property? Dave, let's start with you. What's the difference between a financial planner and a property planner?
Well, look, I mean, basically there's some broad similarities. They understand the client's situation and long-term goals. They'll put together a long-term plan to meet the goals, but really a property planner pretty much predominantly focuses on that, whereas with a financial planner, it's more of a smaller part of the overall picture. So I think that's a big difference. They both look at financial outcomes and implications of the decisions to be made. Financial planners, essentially, they provide advice on wealth creation in regards to investment portfolios, products, manage investment schemes and shares. They look at retirement planning, income projections, advice for transition to retirement, all the legalities and rules and regulations around that. Aged care planning, times, depending on the quality of the financial planner, inheritance, death planning, again, depending on the amount of money you're willing to spend on the advice, really. Big one for financial planners, and what really underpins a lot of their wealth or their personal wealth creation and their income is insurances. Yeah. So they do focus a lot on insurances, and there's pretty large premiums that they're eligible for. And, in reality, and having owned a financial planning business must have been close to a decade, there is some ongoing work with risk insurances, but not that much unless people make a claim or you're switching them to get a new income. So, and they tend to go up over time. So, for example, a recurring mortgage income tends to go down over time. So that's a big part of what they do. They should be experts in superannuation and SMSF as it pertains to investing. They potentially can help with business planning. Very good ones potentially can. Generally, they're licensed, aren't licensed to provide advice on property. And although property is unregulated, they're generally, from my experience, actively discouraged by their dealer groups or licensees to provide guidance on property. Yeah, so that's a big difference with financial planners. And, they can partner with spruikers, whether or not they realise it. and they can get kickbacks working with developers, which can be pretty large kickbacks. Now, so can mortgage brokers, so can, accountants. But look, that's a bit of an overview of what financial planners do and some of the similarities.
Yeah, it's a great overview. And look, this is, as you said, it's a regulated space, and there have been a lot of changes flow through financial planning and the whole industry over the last 10 years. And it's been quite brutal for a lot of businesses. And, there are a lot of really good financial planners that were impacted by that as well. So, there's been a lot of changes since the good old days. And Mike, this isn't an unusual situation. So many financial planners do feel negatively towards property. And, I've got some theories. What do you think?
I think I could summarize what Dave said in one sentence, and that's managed funds and insurances. I mean, that's their wheelhouse. And, I've done a podcast episode on this exact problem before, and I think it comes down to the fact that they can't make any money in property, right? Because they're not really qualified to advise, and it's a litigation nightmare for them if they get that advice wrong, because, you just look at the title, they're a financial planner. So if they recommend a product that doesn't grow, then they're kind of liable for that mistake. So that's the real issue, that there's no way for them to make money in it because they can't do it. The risk reward ratio is not there for them, and then they're not really allowed to recommend one property over the other. So that's kind of why I think they're kind of anti-property, and in their heart of hearts, like, they're probably not anti-property. Yeah. They probably own property themselves. But if you want advice on investing in property, a financial planner is not the obvious place to go for me. In fact, quite the opposite.
It's really interesting. And look, obviously the ones that I think do it really well understand the merit of the asset class and have some really good understanding of, what constitutes a good decision versus a not so great decision. They're the ones that reach out to me. So I know them. And I've met some really impressive financial planners that could be amazing advocates with, additional training. There's no doubt about it. But I've come across so many that are anti-property as well. So it is an interesting debate. I've got a few thoughts on this. Anyone can buy shares or property, and a lot of people do. Financial planners would see terrible outcomes and results, and we all know that reversing a bad property decision is far harder than reversing a poor share decision. Think about the conversations that they have in their offices when people come in and, they're in tears and they've made a mess of something. Financial planners often see people when they've made a big mess and they need help getting out of a situation. And, buying and selling property, it takes time, and there's less liquidity and less flexibility in property as an asset class than others like shares. You can't sell a third of a property easily. So back to the liquidity issue, but you can sell a third of a share portfolio pretty easily. And the buying and selling costs are way more prohibitive in property. Property can cause stress and cost time when it comes to fixing physical issues or fighting things in a tribunal. You won't come across that with shares. Property involves other people more than shares do. So you're dealing with other third parties, tenants, property managers, legal reps. So a financial planner who's giving advice across a situation that's within the property space, they're going to have to take into account a lot more situations and opinions in most cases. Leveraging and lending is more severe. So while there's more opportunity to get your hands on more money, that amplifies your risk. And if you get things wrong, it amplifies your loss. So, that's something that I'm sure many advisors have seen and would prefer to shy away from. Properties are unique as well. So unlike shares, it takes a lot of due diligence just to buy one property, and you've got many facets to look at. Whereas, shares, you've got quite a lot of things to compare, and obviously by parcel of shares are all uniform. And there's more taxes on property investing. Tax is a big part of their advice and their consideration as well. So they're just a handful of reasons why I think a financial planner would look at property and just think, oh, it's all too hard or too risky or too ugly. That's my thinking.
Yeah. I think after you, Dave.
Look, I was just going to say I agree. I didn't want to go too hard on financial planners, but I agree with a lot of what you said, Mike, as well, and what you've just said there, Cate, too. I think from a high level, property planning is much more specialised, whereas financial planning is more, you're more like a GP. You're across a lot of different areas that you're working with your clients on. So, with property planning, it's just purely focusing on property decision making. It's purely focusing on the long-term planning of your property decisions, the financial outcomes, how they look at retirement, how that marries up with your goals. One of the biggest ones is the depth you go into with lifestyle planning and events, considerations and outcomes with property planning. And that's because, buying a home for so many people is so important. And, we don't live in a share, to state the obvious, or manage funds. We live in a house. And so that does add a huge layer of complexity to our property strategy. And, that is the type of thing, a lot of time can be spent working through the timing between and the considerations around when you buy a home versus when you buy your investment properties, where the price points sit. That a financial planner doesn't have the time to go into that level of depth around these types of decisions. We also will map out multiple different journeys for our clients. Again, a financial planner won't do that, probably can't do that unless you're willing to pay probably $10,000, $20,000+. I mean, our fees are actually only around a few $1,000s for a property plan. So, there's a lot of differences, but these are a few. I've got more, but they are some of the ways a property planner certainly differentiates from a financial planner.
Yeah, agree. So what can people do if they feel their financial planner is closed-minded about property? What are the options?
It's funny getting back to the original question. We found ourselves being told repeatedly what we cannot do. I think that's an unusual position for a financial planner to say, oh, you can't do that. Like, they might say, I wouldn't advise that for these reasons because of these risks, but they shouldn't be saying what you can and can't do with your money. That's a bit of an odd one. I think also, if you think about the financial planning industry, similar to mortgage brokers, they all kind of live underneath an aggregator, and they're relying on the research that's done by that aggregator. So that the research is going to be focused on shares because that's where that business makes money, right? So they're not going to have that big research capability plugged into their financial planning practice. So it's always going to be kind of biased that way. But I think, Cate, you raised a really good point in the notes. It's just asking that question about, okay, well, I understand that, you're a bit anti-property, or you think we shouldn't diversify into property, but if that's a decision that we want to come to, who would you recommend that we talk to? And I think, as you mentioned, they're either going to say, oh, well, this person's a great authority on the subject, or they should know people in the property space. Like, after all, they're in the wealth creation business. They should at least know people that they can refer to, or know people by reputation to say, look, this person seems like a good operator. But if they're pushing back, sort of saying like, oh, there's nobody that's going to look after you, or, they're all just spruikers, that's kind of maybe a red flag for me to say, maybe you've outgrown your financial planner.
Yes, you've made some good points there, Mike. I think some of the questions that people can ask their financial planner if they're fearful that they're anti-property, first and foremost, is establish whether they're actually anti-property or they're concerned that it's not the right suitable fit for you right now. Because if it's about you and you can get that detail, knowledge is power. You want to understand why they're feeling that you're making a mistake or that it's too risky. If it's about you, listen to them. Next one is ask them why they're recommending an alternative asset class in this particular instance. And they need to have a good reason. If it's because, this is what we always do, or we just, our practice believes in shares, well, there is your answer. And the last one that I've got here is ask them who else they'd recommend that you talk to if you still wish to do it. So just to your point, Mike, they'll have a community, they'll have others that have talked to or worked with or known, mortgage advisors, buyers agents, property planners, they'll have those connections. And if they don't, then you need to get a second opinion.
They should have clients coming to them that will bring a portfolio, right? And then if they can see that that's been successful, an obvious question would be,
Who helped you?
Who helped you? Who helped you to get there? I mean, a financial planner should be curious to anything that they can sort of see as a success metric.
Yeah, from my experience, and they're working inside of a property-focused business. There is a fear of giving advice around property, and that is fed down from the dealer group. And because your files are audited by the dealer group, they're really conscious not to give advice on property, basically, because they're afraid it might cost them with the dealer group and when they're audited. And I think there's also probably often a subconscious, but sometimes a conscious bias towards share investment. And obviously, that's where their bread's buttered. So I think ultimately that's what's happening on a conscious or subconscious level to some degree, other than the very best independent financial planners. And, from my experience, there's very few who really look at property, like a very small percentage who are able to view property as, in an unbiased and independent manner, without that sort of without that fear of the repercussions of advising on property that might come / the impact on their income.
Yeah. Well, on that note, we've come to the end of our episode for listener questions this week, and I'll get you both to put on your thinking caps for your gold nuggets.
Now it's time for us to go mining for our gold nugget property tip of the day.
Going back to my original point, certainly as a self-employed person or a business owner, as I think is more appropriate to say, look at those ad backs. Make sure that your accountant is submitting your financial figures to the broker with a little bit of an insight into saying, is this a one-off expense? And I think just for the financial planning question, just ask the hard questions. Just say, we want to diversify. We're interested in property. Are there reasons why you're not recommending it? And it might be genuine reasons that they think, look, I just think it's a little bit too risky in your situation, or I think that's an approach in a couple of years when you built the asset pool. Or they might just say property is rubbish. And, depending on the answer will depend on whether you feel like they're the right person to keep doing business with.
My gold nugget's short and sweet, and it's about Kim's question. I think anyone who's looking at opportunities to get into the property market and feeling like they'd love a bit of help from the government, get in touch with what the opportunities are. We're going to pop these in the show notes. The federal opportunities, the state-based opportunities, we'll have all of the links there. See what you can get your hands on to get a little bit of help to get on that property ladder.
Awesome. My gold nugget is just answering a bit more of Kim's actual question. So a few things that a property planner does differently to a financial planner. So the financial modelling we complete, it looks at various different timeframes and impacts of timing of property decisions regarding cash flow, future changes in your lifestyle decisions. Could be when kids go to private school, can be when you how much you spend on holidays, when you upgrade the car, whole range of things, and that's over multiple different journeys. Whereas most financial planners will only do one journey. We look at the property strategy. Should it be an investment or a home next? What's the right price point for you? How does that interlink with your mortgage strategy? What is a macro location that suits your price point? What are then some micro locations, suburbs you could be looking at, or regional centres, different states, looking at property selection education, what does a good asset look like, etc. Negotiation, general guidance on dealing with agents and approaching a negotiation. They'll support you with mortgage strategy, optimising your tax deductions, money management, property is not in their wheelhouse, so generally they don't want to stray there. There's just too much work involved, just building on some of what Kate's already said in property advice, and they don't want to spend the time doing it. I mean, property is a very complex asset. It is incredible personal in terms of preferences, particularly around the ideal home, and no two properties are the same. So, it's very different to here's product X and here's product Y, and the fees and expected yield, pick one. So, and that's not all financial planning is, but that is part of it. And it takes a long time, again, as Cate said, to make a property decision, whether it's home or investment, purchase, price, location, asset type, yield, capital growth, target, tenant, etc. So, it's specialisation versus the GP.
Awesome.